Before we dive in, a quick but important legal disclaimer. I am not a financial advisor, and this video is for educational and informational purposes only. It should not be considered financial or investment advice. Investing involves risk, including the potential loss of principal. Always do your own research and consider consulting with a qualified financial professional before making any investment decisions. Alright, let's get real for a second. Picture this. You land your first big job, you're feeling on top of the world, and then you're handed a thick packet of papers for your new 401k. You open it up and your brain just shuts down. You're hit with a wall of words you've never seen before. Aggressive growth. Target date 2065. Small cap value index. International blend. Feels like a different language. So what do most of us do? We either close our eyes and point to one at random, or we sheepishly ask the person in the next cubicle what they picked and just copy them. We treat one of the most important financial decisions of our lives with the same strategy we used to pick a science fair project in middle school. If that sounds even remotely familiar, you are not alone. And that feeling of confusion, that sense of just guessing with your future, that ends today. Because the vast majority of those options, the engine behind most retirement accounts in America, are built on something called a mutual fund. And by the end of this presentation, you will understand exactly what a mutual fund is, how it works, and why it is the single most popular investment tool for everyday Americans. We are going to strip away all the jargon, all the complexity, and break this down so simply that you'll be able to explain it to your friends over dinner. This isn't about becoming a Wall Street trader. It's about gaining the confidence to take control of your own financial future. So, what on earth is a mutual fund? Forget the complicated charts and the guys in suits yelling on TV. I want you to imagine something much simpler. A giant investment potluck. Let's say you and 100 of your friends all want to throw an incredible dinner party. A feast. You want appetizers, a main course, side dishes, desserts, the works. But there's a problem. If you try to buy all the ingredients and cook this amazing feast all by yourself, it would be incredibly expensive and take a ridiculous amount of time. You can't afford to buy the prime rib, the fresh salmon, the organic vegetables, and all the fancy spices. You'd go broke. But what if you and all your friends decided to pool your money together? You each throw in, say, $50. Now, instead of just your $50, you have a collective pot of $5,000. Suddenly, buying all those amazing ingredients is not only possible, it's easy. But there's another problem. Who's going to do the shopping? Who knows which butcher has the best cuts? Who has the time to go to 3 different markets to get the freshest produce? And who has the skill to actually cook all of this into a delicious, balanced meal? Probably not you, you're busy with your job. So, with your big pool of money, you do something smart. You hire a professional chef. This chef is an expert. Their entire life is dedicated to sourcing the best ingredients and creating incredible meals. They take your $5,000 pot, they go to the market, and they don't just buy one thing. They buy a little bit of everything. They get the beef, the chicken, the fish, a dozen different vegetables, fruits, grains. They create a massive, diversified feast. When the meal is ready, everyone who chipped in $50 gets a plate. Your plate has a little bit of everything on it, a perfectly balanced portion of the entire feast. You get to taste everything without having to buy it all yourself. That, right there, in its simplest form, is a mutual fund. Let's swap out the potluck terms for the real financial terms. The group of friends? Those are the investors. That's you. The money you all chipped in? That's the capital. The professional chef you hired? That's the fund manager. The giant, diversified feast they created? That is the fund's portfolio. And the individual ingredients, the beef, the chicken, the vegetables? Those are the actual investments like stocks, bonds, and other assets. Your plate, your personal portion of the overall feast, is your share in the mutual fund. You are buying a small piece of a very, very large, professionally managed pie. Or in our case, a potluck feast. This simple idea solves 2 of the biggest problems that normal people face when they try to invest on their own. The first, and arguably the most important, is diversification. You've heard the old saying, don't put all your eggs in one basket. It's cliché for a reason. It's brilliant advice. If you take all your savings and buy stock in just one company, say a hot tech startup, you're making a massive bet. If that company soars, you're a genius. But if that company fails, you lose everything. It's incredibly risky. A mutual fund is the exact opposite of that. The fund manager, our professional chef, is specifically buying hundreds, sometimes thousands of different ingredients or stocks. They might buy a little bit of Apple, a little Microsoft, some Johnson & Johnson, some Coca-Cola, maybe some bonds from the US government, and shares in international companies you've never even heard of. Now think about what this does for your risk. If one of those companies has a terrible year, does it ruin the whole portfolio? No. It's like one of the side dishes at the potluck being a little burnt. It's disappointing, but you've still got dozens of other delicious things on your plate. The success of the other investments helps balance out the failure of the one. This is diversification in action. It's the closest thing to a safety net in the world of investing. With a single purchase of one mutual fund share, you can instantly own a tiny slice of hundreds of different companies, achieving a level of diversification that would be practically impossible and wildly expensive to create on your own. The second huge problem it solves is the need for professional management. Let's be honest. Do you have the time to spend 40 hours a week researching companies? To read quarterly earnings reports, analyze market trends, and decide whether a stock in the healthcare sector is a better buy than one in the energy sector? Of course not. You have a life. You have a job, a family, hobbies. The fund manager and their team of analysts, that is their entire job. They are paid to do that deep dive research for you. They are constantly monitoring the investments in the portfolio, making decisions to buy or sell based on their expert analysis of the economy and the markets. You are essentially outsourcing the most difficult and time-consuming part of investing to a full-time professional. You're paying for their expertise, their time, and their resources, all bundled into the fund you own. So let's recap what we've learned so far. A mutual fund is simply a pool of money from thousands of investors. That pool of money is then handed over to a professional manager who invests it in a wide variety of assets, like stocks and bonds. This gives you, the investor, two incredible advantages right off the bat. Instant diversification, which lowers your risk, and professional management, which saves you an enormous amount of time and effort. It's an elegant solution that allows millions of regular people to participate in the growth of the largest companies in the world without needing a finance degree or a fortune to get started. It sounds almost perfect, doesn't it? A professionally managed, automatically diversified investment. But this is where the story gets more interesting. How do you actually make money from this? If you own a tiny slice of 1,000 companies, how does that turn into more dollars in your account? And what about the costs? That professional chef isn't working for free. What are the hidden fees and expenses that can eat away at your profits over time? Understanding that is the key to choosing the right fund and avoiding the wrong one. So let's talk about that chef. That team of financial experts isn't just volunteering their time out of the goodness of their hearts. They're running a business, and you, the investor, are the customer. And like any business, there are operating costs. This is, without a doubt, the single most overlooked and misunderstood aspect of mutual funds for beginners. And it can be the difference between a comfortable retirement and wondering where all your money went. The most important cost you need to understand is called the expense ratio. Think of it as an annual membership fee for the fund. It's expressed as a percentage of your total investment, and it's deducted from the fund's assets every single year, automatically. You don't get a bill in the mail for it. It just gets quietly skimmed off the top of the fund's overall performance. If your fund holds $1 million in assets and has a 1% expense ratio, that means $10,000 is coming out that year to cover costs, which reduces the overall return for you and every other investor. So what does this fee actually pay for? It's generally broken down into three main ingredients. First, and usually the largest piece, is the management fee. This is the salary for our head chef, the portfolio manager, and their team of sous chefs, the research analysts. These are the people actively researching companies, analyzing market trends, and making the buy and sell decisions. They're the supposed brains of the operation that you're paying for. Second, you have administrative costs. This is the boring but essential stuff. It's the cost of running the restaurant itself, keeping the lights on, paying the rent, handling the legal paperwork, tracking all the investments, and sending you those account statements in the mail. It's not glamorous, but it has to be paid. And third, you have a particularly sneaky fee that you need to watch out for, called a 12b-1 fee. This is basically a marketing and advertising fee. The fund uses this money to pay for commercials, online ads, and commissions to brokers to convince new people to invest in the fund. Now think about that for a second. You, an existing investor, are paying a fee out of your investment to help the fund company find more customers. It's like going to a restaurant, and part of your bill includes a charge for the TV commercial you saw that convinced you to go there in the first place. For many investors, this fee feels like a raw deal, and it's a big reason why you should always look for funds with very low, or ideally zero 12b-1 fees. Now you might be thinking, okay, a percentage. How bad can it be? 1% sounds tiny. This is the trap. This is the illusion that has cost investors trillions of dollars over the decades. 1% doesn't sound like much, but over time, thanks to the brutal reverse logic of compound interest, it can be an absolute anchor on your wealth. Let's run a quick scenario. Imagine you have $10,000 to invest. You find two different mutual funds that invest in the exact same types of stocks. Let's call them Fund A and Fund B. Both funds, before fees, manage to earn an average return of 8% per year. The only difference is their cost. Fund A is a low-cost fund. Its expense ratio is a lean 0.1%. Fund B is a more traditional, higher-cost fund. Its expense ratio is 1%. A difference of less than 1 percentage point. Seems negligible, right? Let's see what happens. After 1 year, your $10,000 in Fund A, earning 8% minus the 0.1% fee, grows to $10,790. Your $10,000 in Fund B, earning 8% minus the 1% fee, grows to $10,700. A difference of $90. You might not even notice. You might say, who cares? But we're not investing for 1 year. We're investing for the long term. Let's fast forward 30 years. Assuming you don't add another penny, that initial $10,000 in the low-cost Fund A would have grown to approximately $95,000. But that same $10,000 in the higher-cost Fund B, it would have only grown to about $76,000. That is a $19,000 difference. Almost double your initial investment has vanished into thin air, eaten away by a seemingly tiny 0.9% difference in fees. It's not money you lost because the market crashed. It's money you simply transferred from your pocket to the fund company's pocket, year after year after year. And the worst part? The fund manager gets paid that fee whether your investment goes up or down. If the market has a terrible year and your fund loses 20%, you still pay that 1% fee. The chef gets paid even if they burn your dinner. But wait, it gets worse. The expense ratio is just the ongoing annual fee. Some funds also charge you a commission just for the privilege of investing your money with them. These are called sales loads. Think of a load as a cover charge to get into a club or a ticket to an event. It's a one-time fee. There are a few different flavors. The most common is a front-end load. This is a percentage you pay right off the top the moment you buy the fund. Let's say a fund has a 5% front-end load. If you decide to invest $10,000, that 5%, $500, is immediately taken out as a commission for the financial advisor or broker who sold you the fund. Only the remaining $9,500 actually gets invested. Your investment is literally starting in a hole. You need to make a 5.3% return just to get back to even. Then there's the opposite, a back-end load, also known as a contingent deferred sales charge, or CDSC. With these funds, you don't pay anything up front. Your full $10,000 gets invested. However, if you decide to sell your shares, you get hit with a fee on the back end. Typically, this fee gets smaller the longer you hold the investment. For example, it might be 5% if you sell in the first year, 4% in the second year, and so on until it disappears completely after, say, 6 or 7 years. The fund company does this to discourage you from pulling your money out too quickly. It's like a penalty for leaving the party early. And finally, there are funds with a level load. These often don't have a front-end load and may have a small back-end load that only lasts for a year. But the catch is they usually have much higher annual expense ratios, specifically those 12b1 marketing fees we talked about. So you're not paying a big one-time ticket price, but you're paying a higher price for every single thing you buy inside forever. So you've got annual expense ratios slowly bleeding you dry, and you've got sales loads taking a big chunk right off the top or on the way out. Can feel like a minefield. But here is the good news. For every one of these expensive, fee-laden funds, there is an alternative. There are thousands of what are called no-load funds. A no-load fund is exactly what it sounds like. A fund with no front-end load and no back-end load. You don't pay a commission to buy it and you don't pay a commission to sell it. The money goes from your bank account directly into the investment and vice versa. Now, this is a critical point. No-load does not mean no fee. This is a rookie mistake. No-load funds still have an expense ratio. They still have management and administrative costs. But by choosing a no-load fund, you've eliminated the cover charge. You're no longer paying a massive, unnecessary commission just to get in the door. And in today's world with so many incredible low-cost, no-load funds available directly to investors, there is very little reason for most people to ever pay a sales load. So, how on earth do you find all this information? It sounds like it's buried in the fine print. And it is, but there's a map. Every mutual fund is required by law to publish a document called a prospectus. Think of it as the fund's official user manual. It details the fund's investment objectives, strategies, the risks involved, and most importantly, a standardized table of its fees. While the full prospectus can be a dense, legal document, funds also provide a summary prospectus, which is much shorter and easier to read. And right near the very beginning of that summary, you will find the fee table. It will clearly list the sales loads, if any, and break down the annual expense ratio. This little table is your best friend. Before you ever consider investing a single dollar into a fund, you must find and read this table. It tells you exactly how much of your money is going to work for you, and how much is going to the fund company. Because at the end of the day, fees are the one thing in investing you can actually control. You can't control whether the stock market goes up or down. You can't control whether a company beats its earnings estimates. But you can absolutely control how much you're willing to pay for the management of your money. And choosing a fund with a low expense ratio and no sales load is the closest thing to a guaranteed head start you can get. Okay, so we've pulled back the curtain on the costs. We know how the fund company makes its money, but now we get to the exciting part. The menu itself. What are you actually buying? What are the different types of mutual funds out there? You've got stock funds, bond funds, index funds, international funds, target date funds. The list goes on and on. Each one is like a different dish, designed for a different taste and a different goal. How do you know whether to order the aggressive growth steak or the slow and steady vegetable soup? How do you build a full, balanced meal for your financial future? That's exactly where we're headed next. So you're staring at this massive financial menu and the waiter, let's call him Wall Street, is tapping his pen, waiting for your order. On one side, you have the sizzling, high-protein entrees. On the other, the steady, reliable soups and salads. And in the middle, you have these combo platters that promise a bit of everything. It's overwhelming. But here's the secret. You're not just ordering one dish. You're building a meal. And every great meal starts with understanding the main food groups. In the world of mutual funds, these food groups are your primary asset classes. Let's start with the star of the show, the one that gets all the attention, stock funds. Think of stock funds as the main course. This is your protein, your growth engine. When you invest in a stock fund, you're buying a tiny slice of ownership in dozens, or even hundreds of different companies. The goal here is simple and ambitious: growth. You want the value of those companies and therefore your investment to go up over time. This is what financial advisors call capital appreciation. It's the steak on your plate. But not all steaks are the same, right? You've got your lean filet mignon and your fatty marbled ribeye. Stock funds are just as diverse. First, you have growth funds. These are the funds that invest in companies poised for explosive expansion. Think of the hottest tech startups, biotech firms on the verge of a breakthrough, or innovative companies changing the way we live. These are the high flyers. They're exciting, they have the potential for massive returns, but they're also volatile. They're the financial equivalent of a triple shot espresso. A huge jolt of energy, but they can also make you jittery. If you're young with decades to invest, a little bit of this high-octane fuel can seriously power your portfolio. On the opposite side of the grill, you have value funds. These funds are like treasure hunters. Their managers sift through the market looking for forgotten gems, solid, reliable companies that Wall Street has overlooked for some reason. Maybe they had a bad quarter, or they're in an unglamorous industry. But the value investor believes their stock price is cheaper than what the company is actually worth. They buy low, hoping the market will eventually recognize its mistake and the price will rise. Think of a classic, well-built pickup truck. It's not flashy, it's not the fastest thing on the road, but it's dependable and built to last. It's the Warren Buffett style of investing. Then you have what is arguably the most popular dish for new investors: index funds. If a growth fund is ordering a specific fancy dish, an index fund is like hitting the world's most efficient buffet. Instead of trying to pick individual winning companies, an index fund simply buys all the companies in a major market index like the S&P 500. The S&P 500 is just a list of the 500 largest, most influential public companies in the US. So, an S&P 500 index fund gives you a tiny piece of Apple, Microsoft, Amazon, and 497 others all in one go. You're not trying to beat the market, you're trying to be the market. It's a powerful, low-cost, and historically proven strategy for long-term growth. So those are the main courses. But no meal is complete with just a slab of protein. You need balance. You need something to stabilize the plate. And that brings us to our second major food group, bond funds. If stock funds are the engine of your portfolio, bond funds are the brakes and the suspension system. They're the vegetable soup. They aren't designed for explosive growth. Their purpose is stability and income. When you buy a bond, you're not buying ownership in a company. You are essentially loaning money to a government or a corporation. In return for your loan, they promise to pay you back the full amount on a specific date, and along the way they pay you regular interest payments. A bond fund simply pools your money with other investors to buy hundreds of these different loans. The interest they collect is then passed on to you, usually as a monthly or quarterly dividend. This creates a predictable stream of income. It's less risky than stocks because even if a company's stock price is going crazy, they are still legally obligated to pay back their loans. That's why when the stock market panics and plunges, investors often flock to the safety of bonds, which helps cushion the blow to your overall portfolio. It's the steady, reliable part of your meal that keeps you full and nourished, even when the main course is a little too spicy. Next up, we have the financial equivalent of a tall, cool glass of water. It's not exciting, but it's absolutely essential. I'm talking about money market funds. These funds invest in very safe, very short-term debt, things like government treasury bills that mature in just a few months. The goal here isn't growth or even significant income. The goal is preservation of capital. It's a parking spot for your cash. Money market funds aim to keep their share price locked at a stable $1. You put $1 in, you get $1 out, plus a little bit of interest. It's often used for emergency funds or for money you know you'll need in the near future. It's a place to keep your cash safe from the wild swings of the stock market, while still earning a little more interest than a typical checking account. It's the ultimate in low-risk, low-return investing. It won't make you rich, but it won't let you go thirsty. Okay, so we have our main course stocks, our healthy side dish bonds, and our glass of water money market. Now what if you don't want to play chef? What if you just want to order a pre-made, perfectly balanced meal? That's where our last category comes in: balance funds and their smarter cousin, target date funds. A balance fund is exactly what it sounds like. It's a single mutual fund that holds a preset mix of both stocks and bonds. A classic example is a 60-40 fund, which keeps 60% of its assets in stocks for growth and 40% in bonds for stability. It's a one-stop shop. The fund manager does all the work of maintaining that balance for you. It's the combo meal on the menu. You get the burger, the fries, and the drink all in one package. It's simple and effective. But then, financial innovation took it a step further. It created something truly brilliant for the everyday investor: the target date fund. Imagine a chef who not only cooks your meal but automatically changes the recipe over the years to match your changing dietary needs. That's a target date fund. You pick a fund with a year in its name that's closest to when you plan to retire. Let's say a Target 2055 fund. When you're young and retirement is decades away, that 2055 fund will be aggressive. It might be 90% stocks and 10% bonds, going all in on that long-term growth. You have plenty of time to recover from any market downturns. But as you get closer to the year 2055, the fund automatically and gradually shifts its own mix. It sells off some of its riskier stocks and buys more stable bonds. By the time you're ready to retire in 2055, the fund might look more like 40% stocks and 60% bonds. It automatically becomes more conservative to protect your nest egg as you get closer to needing it. It's a set-it-and-forget-it strategy that aligns your investment risk with your time horizon. For millions of Americans with a 401k, the target date fund is the default, and for good reason. It puts your investment plan on autopilot. So there it is. The four main food groups on the mutual fund menu: stock funds for growth, bond funds for stability and income, money market funds for safety and cash parking, and balanced or target date funds for an all-in-one, automated solution. Understanding these categories is the first giant leap toward building a portfolio that works for you. It's about knowing that you don't just order the steak. You need the vegetables too. You need to build a full plate. A meal that can fuel your journey from where you are today to where you want to be decades from now. But now that you know what kind of food you want to order, a crucial question remains. How do you read the label? How do you know what's really inside that fund? How much does it cost and what are the hidden fees? Because every item on this menu has a price tag and a list of ingredients. And if you don't read the fine print, you could end up paying way too much for a meal that isn't even good for you. Uncovering that fine print, decoding the language of expense ratios, loads, and the prospectus, that's exactly where we're going next. And if you don't read the fine print, you could end up paying way too much for a meal that isn't even good for you. Uncovering that fine print, decoding the language of expense ratios, loads, and the prospectus, that's exactly where we're going next. Think of your investment portfolio as a bucket you're trying to fill with water. Every dollar you invest is another drop of water. But what most people don't realize is that most mutual funds have tiny, almost invisible holes drilled into the bottom of that bucket. These holes are the fees. And while one tiny drip might not seem like a big deal, over decades, those drips can drain a shocking amount of your wealth. Our job today is to find those holes and plug them. The first and most important one to find is called the expense ratio. This is the most persistent, the most common, and the most silently destructive fee in the entire investment world. It's not a one-time charge. It's an annual fee, deducted from your investment, every single year, whether the fund makes money or loses money. It's like a subscription service you can't cancel. It pays for everything: the fund manager's salary, their team of analysts, the office rent, the marketing budget, the paper clips. Everything. It's expressed as a percentage, and that's where they get you. A 1% expense ratio sounds trivial. It's 1 penny for every dollar. What's the big deal? Well, let's run the numbers. Let's say you invest $10,000 into a mutual fund. And let's assume it grows at a healthy 8% per year for 30 years. Now let's look at two versions of this story. In version 1, you're in a low-cost fund with a 0.1% expense ratio, 0.1%. In version 2, you're in a higher-cost fund with a 1.5% expense ratio. That difference is just 1.4%. Seems like pocket change. It is not pocket change. After 30 years in the low-cost fund, your $10,000 would have grown to about $95,000. Not bad at all. But what about the fund with the slightly higher fee? That 1.5% expense ratio? After 30 years, your $10,000 would have only grown to about $66,000. Let that sink in. A fee difference that sounds like nothing, just over 1%, cost you $29,000. Almost 3 times your initial investment vanished. Gone. It didn't disappear in a big, dramatic market crash. It was siphoned out drip by drip, year after year, by the silent killer, the expense ratio. Over a lifetime of investing, this single number can be the difference between a comfortable retirement and working an extra decade. It is the single most important number you need to look for. But wait, there's more. The expense ratio is the silent killer, but sometimes funds employ a more aggressive, in-your-face mugger. These are called loads. A load is just a fancy word for a sales commission. It's a fee you pay either when you buy the fund or when you sell it. Let's start with the most common one, the front-end load. These are often found in what are called Class A shares. Think of this as a cover charge at a nightclub. You have to pay the bouncer just to get in the door. Let's say a fund has a 5% front-end load. You decide to invest that same $10,000. You hand over your check, but before your money even gets a chance to start working for you, the fund schemes 5% right off the top. $500. Poof. So, from day one, you're not investing $10,000. You're investing $9,500. You are starting the race already behind. You need to make a 5.26% return just to get back to even. It's a massive immediate handicap. Financial advisors who sell you these funds will say the load pays for their expert advice. But today, with so many incredible low-cost, no-load funds available, paying a front-end load is like paying someone $500 to tell you that water is wet. Then you have the sneaky cousin, the back-end load. These are often called contingent deferred sales charges, or CDSCs, and are typical of Class B shares. The sales pitch for these is tempting. No upfront fee. Your entire $10,000 goes to work for you from day one. Sounds great, but there's a catch, and it's a big one. The back-end load is a penalty for selling your shares within a certain period, usually 5 to 7 years. It's like a cell phone contract from the early 2000s. Sure, the phone is free, but if you want to leave, you're hit with a massive early termination fee. The fee usually starts high, maybe 5% or 6% if you sell in the first year, and then it slowly decreases each year until it finally disappears. They are trapping your money. If a family emergency happens in year 2 and you need to pull your investment out, you're paying them a hefty percentage just to get your own money back. To make matters worse, Class B shares often have higher annual expense ratios than their Class A counterparts to compensate the broker, so you're getting hit with that silent drip, drip, drip the entire time. And finally, there's the third type, often called level load, or Class C shares. These might be the most deceptive of all. They typically have no front-end load and only a small back-end load that disappears after just 1 year. Sounds like the best of both worlds, right? Wrong. The trap here is that Class C shares carry the highest annual expense ratios of all. That 1% or 1.25% fee, which is sometimes called a 12b1 fee, never goes away. It's a permanent, high-level drain on your bucket. These are designed for short-term investors, but many people are sold them and hold them for decades, getting absolutely fleeced by fees year after year. So you have the bouncer fee, the exit penalty, or the permanent high-price subscription. Is there a better way? Yes. It's called a no-load fund. A no-load fund is exactly what it sounds like. A fund with no sales commission, no front-end load, no back-end load. You invest $10,000 and $10,000 goes to work for you. Simple as that. But, and this is critical, no load does not mean no fee. No-load funds still have expense ratios. The goal, the holy grail for a smart investor, is to find a no-load fund with a very, very low expense ratio. So how do you find all this information? How do you uncover these hidden costs? It's all located in a document that feels like it was designed to be ignored. It's called the prospectus. The prospectus is the legal document that a mutual fund must file with the Securities and Exchange Commission, the SEC. It's long, it's dense, and it's full of legalese. But it is also the one place where the fund is legally required to tell you the absolute truth about every single fee they charge. You don't need to read the whole 100-page document. You just need to know the cheat code. You're looking for one specific section, almost always near the very beginning, called the summary prospectus. And within that summary, you are looking for a magic table. It's usually called fees and expenses of the fund. This table is your treasure map. It will lay out in plain black and white every single cost. It's broken into 2 parts. The first part is shareholder fees. This is where you'll see the maximum sales charge load imposed on purchases. That's your front-end load. You'll see the contingent deferred sales charge load. That's your back-end load. If you see numbers greater than 0 in this part of the table, you should probably just close the document and walk away. The second part of the table is annual fund operating expenses. This is where you find the silent killer. You'll see line items like management fees, distribution 12b1 fees, and other expenses. But all you need to care about is the final number, the bolded line at the bottom, total annual fund operating expenses. That is your expense ratio. That is the percentage that will be dripping out of your bucket year after year. Comparing these tables from 2 different funds is like turning on the lights in a dark room. All the hidden dangers are suddenly revealed. You can see which fund is designed to make you wealthy, and which fund is designed to make the fund company wealthy. These fees aren't just abstract percentages. They are a direct tax on your future. They are the enemy of your wealth. They are cruises you won't take, college tuitions you can't pay, and years of your life you'll have to spend working instead of relaxing. Understanding them, hunting them down, and avoiding them at all costs is the first and most important battle you will fight as an investor. Now that we know how to read the price tag, how do we judge the quality of what's actually inside the box? How do we choose between a fund that tracks the entire US stock market and one that invests in emerging clean energy companies in Southeast Asia? We've learned how to not get ripped off. Now we have to learn how to actually pick a winner. And that means understanding the fundamental choice every investor has to make. The epic battle between active management and passive indexing. This is the single most important fork in the road for any mutual fund investor. It's a philosophical divide that separates 2 entirely different ways of thinking about the market, about money, and about your own chances of success. On one side, you have the rock stars, the celebrity chefs, the master craftsmen. This is the world of active management. An actively managed fund is run by a real person, or a team of people whose entire job, their reason for getting up in the morning, is to beat the market. They are the stock pickers. They pore over financial statements, they interview CEOs, they analyze economic trends, they travel the world looking for the next Apple or the next Amazon before anyone else does. They believe that through superior skill, deeper research, and brilliant intuition, they can pick a portfolio of stocks that will outperform the general market average. Think of it like hiring a personal stylist. You're not just buying clothes off the rack. You're paying a premium for an expert to hand-select pieces they believe will make you look better than everyone else. They'll choose certain fabrics, avoid others, and tailor everything to fit you perfectly. The goal is to look exceptional. In the world of investing, the goal is to get exceptional returns. The promise of active management is tantalizing. Who wouldn't want a genius at the helm, navigating the treacherous waters of the stock market for you? When the market is crashing, a skilled active manager could theoretically sell off risky stocks and move into safer assets like cash or bonds, protecting your money from the worst of the downturn. When the market is booming, they might find that one undiscovered gem of a company that triples in value. This is the allure. It's the story we all want to believe, that we can hire someone smarter than the rest to make us richer than the rest. But that expertise, that promise of outperformance, comes at a steep price. Remember our discussion about the expense ratio? Actively managed funds have much higher expense ratios. You're paying for the manager's salary, the salaries of their whole team of analysts, their expensive research software, their travel budgets, their fancy corner offices. All of that gets bundled into the fee that you, the investor, pay every single year whether the fund does well or not. And this is where the story takes a dramatic, and for many people, a shocking turn. For decades, academics and financial institutions have studied the performance of these highly paid, brilliant active managers. And the verdict is overwhelming. The vast majority of them fail. They don't just have a bad year here or there. Over any meaningful long-term period, 10, 15, 20 years, somewhere between 80 and 95% of actively managed funds fail to beat the very market average they were trying so hard to outperform. Let me say that again because it's the most important, counterintuitive, and often ignored fact in all of personal finance. Most of the professional money managers you pay a premium to beat the market don't. How is this possible? It's a combination of two brutal forces. First, the fees. Imagine the S&P 500 goes up 10% in a year. An active fund manager has to earn more than 10% just to break even with the market after you subtract their fee. If their expense ratio is 1%, they need to generate an 11% return just for you to get the same 10% the market got. They are starting the race a lap behind every single year. The second reason is that the market is incredibly efficient. Millions of smart, motivated people are analyzing the same companies all day long. The second a piece of good news comes out about a company, its price instantly adjusts upwards. The second there's bad news, it adjusts down. Finding a truly undervalued stock, a $100 bill lying on the sidewalk, is extraordinarily difficult because there are thousands of other people looking for it too. The active manager isn't just competing against the market. They're competing against every other brilliant active manager on the planet. It is an incredibly difficult game to win consistently. This brings us to the other side of the fork in the road, the challenger. The quiet, unassuming, and revolutionary idea that turned the entire investment world on its head. This is the world of passive management, also known as indexing. If active management is like hiring a celebrity chef to invent a groundbreaking new dish, passive management is like following a time-tested, proven recipe from a cookbook. You're not trying to be a genius. You're not trying to be creative. You are simply trying to replicate a known successful result reliably and cheaply. A passive index fund doesn't have a star manager trying to pick winners. In fact, it has no stock pickers at all. Its goal is stunningly simple: to own all or a representative sample of the stocks in a particular market index, in the exact same proportions as that index. The most famous index in the United States is the S&P 500. It represents the 500 largest and most influential publicly traded companies in the country. An S&P 500 index fund, therefore, simply buys shares in all 500 of those companies. If Apple makes up 7% of the index's value, the fund makes sure 7% of its money is in Apple stock. If Microsoft is 6%, the fund holds 6% in Microsoft. It's all done by computer. There are no debates, no gut feelings, no brilliant insights. The fund simply buys the entire haystack instead of trying to find the needle. The goal is not to beat the market. The goal is to be the market. By owning a piece of all the biggest companies, you are guaranteed to get the market's return. If the S&P 500 goes up 10%, your investment goes up 10%. Minus a tiny fee. And that's the magic word, tiny. Because there's no star manager to pay, no team of analysts, no research trips to Asia. The expense ratios on passive index funds are incredibly, fantastically low. We're not talking about 1 or 2%. We're talking about 0.1% or even less. Sometimes as low as 0.03%. It is as close to free as you can get. So let's put the two side by side. The active fund promises the chance to beat the market, but comes with high fees and a very high statistical probability of failure over the long run. The passive fund guarantees you will never beat the market, but it also guarantees you will get the market's return reliably and consistently for an almost non-existent fee. And since most active funds fail to beat the market anyway, the passive fund, by simply matching the market and charging next to nothing, ends up outperforming the majority of its high-priced competition. This idea was pioneered by a man named John Bogle, the founder of the Vanguard Group. When he launched the first-ever public index fund in 1976, the Wall Street establishment laughed at him. They called it Bogle's folly. They called it un-American. The idea of just settling for average was an insult to the ego-driven world of high finance. But Bogle's logic was ironclad. He called it the cost matters hypothesis. In investing, you get what you don't pay for. Every dollar you pay in fees is a dollar that is not compounding for your future. Over decades, that 1% or 2% difference in fees between an active and a passive fund doesn't just cost you a little bit of money. It can cost you hundreds of thousands, even millions of dollars in lost growth, thanks to the brutal math of compounding fees. So we have our two heavyweight contenders. The expensive, tailor-made suit of active management, which promises to make you look like a superstar, but often doesn't fit right and costs a fortune. And the simple, reliable, off-the-rack classic of passive indexing, which will never win a fashion award but will always do the job, look perfectly fine, and leave you with a lot more money in your wallet. The evidence is clear on which one has a better track record for the average person. But knowing the difference is only half the battle. How do you actually look at a fund and tell what it is? How do you read the label, check the price tag, and understand the ingredients before you buy? That requires learning to decipher the single most important document for any mutual fund, the prospectus. And that's where we're going next. Think of the prospectus as the official, legally required instruction manual for a mutual fund. Now I know what you're thinking. Instruction manual? I never read those. And you're right, most people don't. We try to assemble the IKEA furniture by looking at the pictures and end up with a wobbly bookshelf and a handful of extra screws. But when it comes to your life savings, you cannot afford to have a wobbly bookshelf. The prospectus is dense, it's boring, and it looks like it was written by lawyers who get paid by the word. And that's because it was. But here's the secret. You don't have to read the whole thing. The Securities and Exchange Commission, the SEC, knows you're busy. So they require every fund to create something called a summary prospectus. It's the Cliff's Notes version. It's usually just a few pages long, and it contains all the mission-critical information you need in plain English to make an informed decision. Finding it is easy. Just go to the fund company's website, or your brokerage's website, type in the fund's ticker symbol, and look for a link that says Prospectus or Summary Prospectus. This is your treasure map. Let's learn how to read it. The very first thing you'll see right at the top is the fund's investment objective. This is the single most important sentence in the entire document. It answers the question, what is this fund trying to do? Is it trying to hit a home run? Or is it just trying to get on base? Is its goal long-term growth, meaning it's willing to take on more risk for the chance of higher returns years down the road? Or is its goal to generate income, meaning it wants to provide a steady stream of cash, like a paycheck, for its investors? Or maybe its objective is capital preservation, which is a fancy way of saying, just don't lose my money. The objective sets the entire tone. A fund aiming for aggressive growth will behave very differently from a fund aiming to preserve capital. If a fund's objective doesn't align with your financial goals, you can stop reading and move on. It's a mismatch. Okay, let's say the objective fits. The next section is where the rubber meets the road. It's the price tag. This section is called Fees and Expenses, and it is the silent killer of investment returns. If you ignore everything else, burn this part into your brain. You'll see a table, and the most important number in that table is the total annual fund operating expenses, more commonly known as the expense ratio. The expense ratio is the percentage of your money that the fund company schemes off the top every single year to pay for their services, the managers, the research, the advertising, the fancy office buildings. It's expressed as a percentage. So, an expense ratio of 1% means that for every $10,000 you have invested, they take $100. Every single year. Whether the fund makes money or loses money, they get paid. Now, 1% might not sound like a lot. It sounds insignificant. But this is the lie that has cost investors trillions of dollars over the decades. Compounding doesn't just work for you. It works against you. Let's run a quick example. Imagine you invest $10,000. For the next 30 years, it grows at an average of 7% per year. But you have two fund choices. Fund A has a low expense ratio of 0.1%. Fund B has a more typical, higher expense ratio of 1.1%. That's just a 1% difference, right? A single penny on the dollar. After 30 years, your investment in the low-cost Fund A would have grown to about $70,000. Not bad. But your investment in the higher-cost Fund B? It would only be worth about $54,000. That tiny, insignificant, 1% difference cost you $16,000. It vaporized nearly a quarter of your potential earnings. The expense ratio is the single greatest predictor of future fund performance. Lower is almost always better. In that same fee table, you might also see something called a sales load. This is just a fancy word for a sales commission. A front-end load is a fee you pay when you buy the fund. A 5% front-end load means if you invest $1,000, $50 immediately goes to the salesperson, and only $950 actually gets invested for you. You start in a hole. A back-end load is a fee you pay when you sell. Many investors today specifically seek out no-load funds, which, as the name implies, have no sales commissions at all. Once you've digested the fees, the next section is principal investment strategies. If the objective was the destination, say, get to California, the strategy is the route you're taking. Are you taking the scenic coastal highway or the direct interstate? This section explains how the fund plans to achieve its objective. Will it invest primarily in large, stable blue-chip U.S. companies? Or will it focus on small, fast-growing tech startups? Will it buy stocks, bonds, or a mix of both? Does it invest in international companies? This is where the fund manager lays out their game plan. Reading this helps you avoid surprises. If you think you're buying a conservative fund and you read in the strategy section that it uses risky derivatives, that's a major red flag. Which brings us to the next section. Principal risks. This is the part of the manual with all the warning labels. Don't read this to be scared. Read it to be smart. Every investment has risk. There is no such thing as a guaranteed return. This section will list things like market risk, which is the basic risk that the entire stock market could go down, taking your fund with it. If it's a bond fund, you'll see interest rate risk, the risk that if interest rates go up, the value of existing bonds goes down. You might see credit risk, which is the risk that a company or government the fund lent money to might not be able to pay it back. Understanding the risks helps you understand the character of the fund and ensures you're comfortable with the potential bumps in the road. Finally, we get to the section everyone wants to look at first: past performance. You'll usually see a bar chart showing the fund's annual returns for the last 10 years. You'll also see a table comparing its performance over 1, 5, and 10 years against a relevant benchmark, like the S&P 500 index. This is crucial. It's not enough for a fund to make money. It needs to make money relative to its peers and its goals. If a U.S. large-cap stock fund returned 8% last year, but the S&P 500 returned 12%, the manager essentially charged you a fee to underperform a simple index you could have bought for next to nothing. But here is the most important warning in all of finance, and it's printed right there below the chart. Past performance is not an indicator of future results. Just because a fund had a hot streak doesn't mean it will continue. The star fund manager might leave. Their strategy might fall out of favor. Luck might just run out. So use this section not as a crystal ball, but as a report card. It tells you how the fund has performed in different market conditions, in bull markets and in bear markets. It gives you a sense of its history, but it does not guarantee its destiny. So there you have it. The prospectus demystified. It's the fund's ID card. It tells you its goal, its price tag, its game plan, its risks, and its report card. By spending just 10 minutes reading the summary prospectus, you move from being a blind passenger to an informed co-pilot of your own financial journey. Now that we know how to read the label on a single bottle, how do we navigate the entire store? The world of mutual funds is vast, with thousands upon thousands of options. They come in different shapes, sizes, and flavors. There are the powerhouse, low-cost index funds that simply try to copy the market, and there are the high-flying, expensive, actively managed funds that try to beat it. There are stock funds, bond funds, balance funds, and everything in between. How do you choose the right category for you, even before you start comparing individual funds? That means understanding the great divide in the mutual fund universe, the epic battle between active and passive investing. And that's our next stop. So let's get right into it. Imagine two chefs are tasked with making a world-class beef stew. The first chef is a culinary artist, a maverick. They believe they can create something truly special, a stew that will taste better than any other stew in the world. They go to the market and handpick every single ingredient. They don't just buy carrots. They search for the sweetest, most vibrant carrots. They don't just buy beef. They analyze different cuts from different farms, looking for the perfect marbling. They experiment with exotic spices, adjust the cooking time based on the humidity in the air, and constantly taste and tweak the recipe. Their goal is not just to make a great stew, but to beat the classic recipe, to create a masterpiece. This chef represents active management. An actively managed mutual fund is run by a portfolio manager or a team of managers who are trying to beat the market. They are that culinary artist. They conduct deep research, analyze financial statements, visit companies, and make calculated bets on which stocks or bonds they believe will outperform. They might decide to sell a popular stock like Apple because they think it's overvalued, and buy into a smaller, lesser-known company they believe is poised for explosive growth. They are actively making decisions, buying and selling, trying to navigate the market's twists and turns to generate higher-than-average returns for their investors. The promise of an active fund is the potential for outperformance. The allure is having a brilliant mind, a supposed market wizard steering your ship. Now let's look at the second chef. This chef is a master of precision and efficiency. They believe that the classic time-tested beef stew recipe is classic for a reason. It's already optimized. Trying to improve it is a waste of time and energy, and more likely to mess it up than make it better. So, this chef gets the exact classic recipe and follows it to the letter. They buy the exact ingredients listed, in the exact quantities. They cook it for the exact time at the exact temperature. Their goal is not to create a new masterpiece, but to perfectly and reliably replicate a proven success. They want their stew to taste exactly like the beloved classic recipe, every single time. This chef represents passive management. A passively managed mutual fund, most often called an index fund, isn't trying to beat the market. It's trying to be the market. It simply aims to replicate the performance of a specific market index. An index is just a list of investments that represents a portion of the market. The most famous one in the US is the S&P 500. It's a list of 500 of the largest, most established American companies. So, a passive S&P 500 index fund doesn't have a star manager making brilliant bets. It has a computer algorithm and a simple mandate: buy all 500 stocks in the S&P 500 in the exact same proportions as the index itself. If Microsoft makes up 7% of the S&P 500's total value, then the fund manager makes sure that 7% of the fund's money is invested in Microsoft. If a company gets added to the index, the fund buys it. If a company gets dropped, the fund sells it. There's no opinion, no genius, no gut feelings. It's a systematic, automated process of mirroring the market. The goal is simply to match the market's return. So we have the epic battle: active versus passive. The ambitious market beater versus the humble market matcher. Which one is better for you? To answer that, we have to look at the two most important factors: performance and cost. Let's start with performance. You'd think that with all those brilliant minds and all that research, the active funds, the master chefs, would consistently beat the simple recipe followers, right? Well, the data tells a fascinating, and for many people a shocking story. Year after year, study after study shows the exact opposite. The vast majority of actively managed funds fail to beat their benchmark index over the long term. Let me say that again because it's the single most important concept in this entire debate. Over any meaningful period like 10, 15, or 20 years, most of the professional, highly paid fund managers who are trying to beat the S&P 500 end up underperforming the S&P 500. How is this possible? There are a couple of reasons, but the biggest one, the giant elephant in the room, is cost. Remember our active manager? The chef handpicking every ingredient and spending hours on research? That expertise isn't free. Actively managed funds have to pay the salaries of the manager and their team of analysts. They have higher trading costs because they're buying and selling more often, and they spend more on marketing to convince you their manager is a genius. All of these costs are bundled into the fund's expense ratio, which is passed directly on to you, the investor. An expense ratio for an active fund might be around 0.75%, 1%, or even higher. Now think about our passive manager, the chef just following a recipe. There's no team of star analysts to pay. The trading is minimal and often automated. The process is incredibly efficient. As a result, the expense ratios for passive index funds are dramatically lower. You can find an S&P 500 index fund with an expense ratio of 0.04% or even less. That difference between, say, a 1% fee and a 0.04% fee might sound tiny, but it is the single most destructive force to your long-term returns. It's like trying to run a marathon with a backpack full of rocks. The active fund manager doesn't just have to beat the market, They have to beat the market by a big enough margin to also cover their own high fees. And that is an incredibly difficult hurdle to clear year after year. Let's put it in dollar terms. Imagine you invest $10,000. Let's assume both the active fund and the passive index fund earn a 10% return before fees over 30 years. The passive fund, with a 0.04% expense ratio, would grow to about $172,000. The active fund, with a 1% expense ratio, would grow to only about $132,000. That's a $40,000 difference. 4 times your initial investment, eaten away by fees. That's money that should have been in your pocket, but instead it went to the fund company. This is the brutal, unforgiving math of compounding fees. So, the evidence is pretty overwhelming. For most people, most of the time, the smarter, more reliable, and mathematically sound choice is passive investing through low-cost index funds. It's the reason why legendary investors like Warren Buffett have repeatedly said that for the average person, a low-cost S&P 500 index fund is the best investment they can make. You get diversification across 500 great companies, you harness the overall growth of the American economy, and you do it all at a rock-bottom cost. Now, does this mean all active funds are bad? No, not at all. There are some truly brilliant managers who do manage to beat the market consistently over time. The problem is, identifying them in advance is nearly impossible. A manager who has a great 3-year track record could just be lucky, and their performance could easily reverse in the next 3 years. Picking a winning active fund is, in itself, as difficult as picking a winning stock. You're betting on the manager. There are some areas where active management might have a better chance. In less efficient markets like emerging international markets or small-cap stocks, where information isn't as readily available, a skilled manager might have a real edge in uncovering hidden gems. But for the core of most people's portfolios, especially the part invested in large U.S. companies, the data overwhelmingly favors the passive approach. Choosing between active and passive is the most fundamental decision you'll make in the world of mutual funds. It's a choice of philosophy. Do you believe you can find a rare genius who can outsmart the collective wisdom of the entire market? And are you willing to pay a high price for that chance? Or do you believe that the most logical path is to simply own the entire market, keep your costs as low as humanly possible, and let the long-term power of compounding do the heavy lifting? Once you've made that choice, the path gets much clearer. You've narrowed down a universe of 8,000 funds to a much more manageable category. Let's say you've listened to the evidence and you've decided the passive, index fund route is for you. You go to your brokerage website and you type in S&P 500 index fund. A list pops up. You see one from Vanguard, one from Fidelity, one from Schwab. They all seem to do the same thing, track the S&P 500. But they have different ticker symbols, slightly different expense ratios, and they talk about things like minimum investments. How do you read the fine print? How do you look at a fund's official documents and pull out the critical information you need to make the final choice between 2 very similar funds? You need to learn how to read the mutual fund's nutrition label. Its prospectus. And that is exactly where we're going next. The prospectus. The very word sounds intimidating, doesn't it? It conjures up images of a phonebook-sized document filled with legal jargon, printed in a font so small you need a magnifying glass. And honestly, you're not entirely wrong. The full statutory prospectus can be a monster. But here's the secret the pros know. You don't have to read the whole thing cover to cover. In fact, regulators have forced these companies to create a shorter, simpler version called the summary prospectus. It's usually just a few pages long, and it contains all the critical information we're about to cover. It's your cheat sheet, your Cliff's Notes. Think of it exactly like that nutrition label on a box of cereal. You don't need to know the entire history of the wheat farm to decide if it's a healthy choice. You just need to check the key facts, the calories, the sugar content, the ingredients. The prospectus is the same. It's designed to answer 4 fundamental questions. What is this fund trying to do? What's actually inside of it? What are the risks? And most importantly, what is it going to cost me? Let's start with the first and most important section. The investment objective and strategy. This is the front of the cereal box. It's the big bold claim. Is this Captain Crunchy's Sugar Blasted Fun? Or all natural fiber twigs? The objective tells you the fund's goal in plain English. It will say something like, the fund seeks long-term capital appreciation. That's code for, we're trying to grow your money over time. Or it might say, the fund seeks to provide current income. Code for, we're trying to generate regular cash payments for you. This is your first filter. If you're a 25-year-old saving for retirement in 40 years, A fund whose main goal is to provide current income is probably not the right fit. You want growth. You want capital appreciation. Conversely, if you're retired and need money to live on, a high-risk, aggressive growth fund is probably a terrible idea. The objective tells you who the fund is for. If it's not for you, you can stop right there and move on. Next, you look at the strategy. If the objective is the what, the strategy is the how. How are they going to achieve that long-term growth? The strategy section will say things like, the fund invests at least 80% of its assets in stocks of large capitalization U.S. companies. Boom! Now you know it's a large-cap U.S. stock fund. Or it might say it invests in investment-grade corporate bonds with a maturity of 5 to 10 years. Now you know it's an intermediate-term bond fund. This section has to match the objective. If the objective is safety and income, but the strategy is investing in speculative, unproven startup companies in emerging markets, you found a major red flag. The front of the box doesn't match the back. Which brings us to our next section, the principal investments. This is the ingredients list. While the strategy gives you the general recipe, this part tells you a bit more about what's actually in the mix. It confirms the types of securities, stocks, bonds, cash equivalents, and might give you a list of the fund's top 10 holdings. This is a fantastic reality check. You might be looking at a global technology fund, and you'd expect to see names like Apple, Microsoft, and Google. But if you look at the top 10 holdings and see a bunch of companies you've never heard of, it tells you this fund might be taking a more aggressive or at least different approach than you thought. There's no right or wrong here, but you need to know what you're buying. You need to know if you're getting the brand name ingredients you expected or a bunch of generic substitutes. Now for the part everyone skips but shouldn't. Principal risks. This is the allergy warning. May contain peanuts. On a mutual fund, this section tells you all the ways you could lose money, and you will see a scary list of them. Don't panic. Every investment has risks. The key is to understand if they are the right risks for you. You'll see market risk, which is the basic risk that the entire stock market could go down, taking your fund with it. That's a standard risk for any stock fund. You might see interest rate risk for a bond fund, which means if interest rates go up, the value of the bonds in the fund could go down. You might also see more specific risks like foreign currency risk, if it's an international fund, or concentration risk, if the fund puts a lot of its money into a single industry, like technology or healthcare. The goal here isn't to find a fund with zero risks. That doesn't exist. The goal is to make sure you're not accidentally signing up for a risk you didn't want. You don't want to buy what you thought was a safe U.S. bond fund, only to find out it has significant emerging market debt risk. Okay, deep breath. We've covered the goals, the ingredients, and the warnings. Now we get to the most important part of the entire document. The one number that can make or break your investment returns over the long run. The price tag. I'm talking about fees and expenses. This information is usually presented in a standardized table, making it easy to compare funds. And it is the single greatest predictor of future fund performance. Not the star manager, not the past returns, the cost. Think of your investment as a bucket you're trying to fill with water. Fees are a slow, constant leak in that bucket. A small leak might not seem like a big deal today, but over 30 or 40 years you can lose a shocking amount of water. The main number to look for is the total annual fund operating expenses, more commonly known as the expense ratio. This is a percentage of your investment that the fund company schemes off the top every single year to pay for the managers, the research, the marketing, and all the administrative costs. It happens automatically. You never see a bill for it. The money is just gone. It's deducted directly from your returns. If a fund has a 1% expense ratio, that means for every $10,000 you have invested, they are taking $100 every single year. That might not sound like a lot, but let's run the numbers. Let's say you invest that $10,000 and it grows at 7% per year for 30 years. In a low-cost index fund with a tiny 0.05% expense ratio, your money would grow to about $75,000. Not bad. But in an actively managed fund with a 1% expense ratio, that same investment would only grow to about $57,000. That tiny leak cost you $18,000. It ate nearly a quarter of your potential gains. This is why costs are king. But the expense ratio isn't the only fee. You also need to watch out for shareholder fees, also known as loads. A front-end load is a sales commission you pay right when you buy the fund. A 5% front-end load means if you invest $10,000, only $9,500 actually gets invested. The other $500 goes straight to the salesperson. A back-end load or deferred sales charge is a fee you pay if you sell your shares within a certain number of years. In today's world, with so many incredible no-load funds available, there is almost no reason for a regular investor to ever pay a sales load. Just avoid them. Finally, we have the last section, past performance. This is usually shown as a bar chart illustrating the fund's total returns for each of the last 10 years. It will also show you a table comparing its performance to a relevant benchmark, like the S&P 500. This is the fund's report card. How did it do in good years? How did it do in bad years? Did it generally keep up with or beat its benchmark? But this section comes with the biggest warning label in all of finance, and you've heard it a million times. Past performance is no guarantee of future results. A fund manager who was a genius last year could be a disaster next year. A hot streak can turn cold in an instant. So, while you should look at it, don't make it your primary reason for choosing a fund. A fund with a decade of great performance and a high expense ratio is often a worse bet than a fund with a decade of average performance and a rock-bottom expense ratio. Costs are forever. Hot streaks are not. So there you have it. The prospectus demystified. It's not a legal monster, it's a simple tool. You check the objective to see if it's for you. You check the strategy and holdings to see what's inside. You check the risks to make sure you're comfortable. And you check the fees to make sure you're not getting ripped off. By spending just 15 minutes reading that summary prospectus, you can save yourself from years of regret and thousands of dollars in hidden costs. Okay, you've done the work. You've learned the theory, you've picked a strategy, and now you've even decoded the secret language of the prospectus. You've found a fund that looks perfect. It aligns with your goals, its holdings make sense, and most importantly, it's low cost. Now what? How do you actually put it in your shopping cart? How do you go from knowing to owning? That's the final crucial step. Navigating the world of brokerage accounts and placing your very first trade. So let's talk about this final barrier, this thing that sounds so official and intimidating, the brokerage account. For years, this term alone was enough to make people's eyes glaze over. It sounds like something you need a secret handshake and a seven-figure income to even look at. But I want you to erase that image from your mind. A brokerage account is not a Wall Street fortress. It's a shopping cart. That's it. It's a special kind of online account that lets you buy and sell investments, like mutual funds. You have a checking account for paying bills. You have a savings account for your emergency fund. And you have a brokerage account for building long-term wealth. It's just another tool in your financial toolbox. And today, opening one is as easy as signing up for Netflix. The first question is, where do you get one? You're essentially choosing which supermarket you want to shop at. For beginners, and honestly for most investors, there are 3 giant, reputable, low-cost supermarkets to choose from: Vanguard, Fidelity, and Charles Schwab. For decades, these 3 have been locked in a price war to make investing cheaper and more accessible for regular people like us. And the winner of that war is you. The truth is, you can't really go wrong with any of them. It's like choosing between Target, Walmart, or Costco. They're all fantastic, they all sell the same essential products, and they'll all get the job done. The key is this. If you think you're going to invest mostly in Vanguard funds, it's often easiest to open an account at Vanguard. If you like Fidelity's funds, open an account there. This often allows you to buy their own house brand funds with 0 transaction fees. But don't get stuck here. This isn't a life or death decision. Pick one and let's move on. The most important decision was the one you already made. Choosing a low-cost, diversified index fund. Choosing the brokerage is just picking the checkout lane. Now, once you go to their website and click Open an Account, you're going to be faced with a critical choice. It's not just one type of shopping cart they offer. They have a few different models, and choosing the right one can be the difference between paying a lot of taxes down the road and paying 0. This is one of the most important financial secrets that wealthy people understand and most others don't. First, you have the standard plain vanilla shopping cart. This is called an individual brokerage account or a taxable brokerage account. It's straightforward. You put money in, you buy your mutual fund, and when you sell it years from now for a profit, you pay capital gains tax on the growth. Simple, flexible, no limits on how much you can put in. It's a great account, but then there are the special carts. The ones with superpowers. These are retirement accounts, and the 2 most common you'll see are the traditional IRA and the Roth IRA. IRA stands for Individual Retirement Arrangement. Think of it as a protective bubble you can put your investments in to shield them from taxes. The traditional IRA is like getting a discount on your groceries today. You put money into this account, and you can often deduct that amount from your income on your taxes for the year. So, you save money on taxes right now. But when you pull that money out in retirement, you have to pay regular income tax on everything, the money you originally put in and all the growth it made over the decades. It's tax deferred. You pay the tax man later. But then there's the other cart, the Roth IRA. And for most people, especially those early in their careers, the Roth IRA isn't just a shopping cart. It's a financial cheat code. It's the closest thing to a magic money machine that the government legally allows. With a Roth IRA, you get no tax break today. You fund it with money you've already paid taxes on. But here's the magic part. Once that money is inside the Roth bubble, it can grow and compound for decades. And when you take it out in retirement, every single penny is 100% tax-free. Let me say that again because it is that important. If you put $5,000 into a Roth IRA today and buy your index fund, and over the next 40 years it grows into, say, $500,000, you can withdraw that entire $500,000 and you will owe the government exactly zero. Nothing. It is all yours. The growth, the dividends, all of it. Imagine working your whole life saving diligently, and then giving away a huge chunk of your nest egg to taxes right when you need it most. The Roth IRA prevents that. It is the single greatest tool for wealth generation available to the average American. There are income limits to contribute and annual contribution limits. You can't put $1 million a year in, but for the vast majority of people, maxing out a Roth IRA every single year is the clearest, most direct path to becoming a tax-free millionaire in retirement. So, you've chosen your brokerage. You've chosen your account type. Let's say you're starting with a Roth IRA, a brilliant choice. The process of opening it is simple. Takes about 15 minutes online. You'll need your social security number, your address, your employer's information, and your bank account details, the routing and account number, to link your bank for transfers. It's all highly secure and standard procedure. Once your account is open, the next step is to move money into it. This is called funding the account. You'll see an option to transfer money, and you'll simply tell it to pull a certain amount, say $1,000, from your linked checking account into your new brokerage account. This usually takes 1 to 3 business days. When the money arrives, it will just sit there as cash like money in a checking account. This is a crucial point. Simply putting money into a brokerage account does nothing. You are not invested yet. You've just moved money from one pocket to another. The final step is to use that cash to actually buy your mutual fund. Okay, deep breath. This is the moment. You're on the website. Your money is in the account. You're ready to go from knowing to owning. Somewhere on the page, you'll see a search bar or a box that says Trade or Transact. You're going to search for the mutual fund you picked out earlier using its 5-letter ticker symbol. Let's use our old friend, the Vanguard Total Stock Market Index Fund, as an example. Its ticker is VTSAX. You type VTSAX into the search bar and hit Enter. A page will pop up with all the details about that fund. You'll see its performance charts, its expense ratio, and a big beautiful button that says Buy. You click it. Now a little order form appears. This is where people sometimes get confused, but it's simple. It will ask you how much you want to buy. Here's a key difference with mutual funds. You don't buy them in shares. You buy them in dollar amounts. So you don't say, I want 10 shares. You say, I want to invest $1,000. You type in the dollar amount of cash you want to use. You'll confirm which account you're buying it in, your Roth IRA, and you'll confirm that you're using the cash that's already sitting in the account. Then you click Preview Order. It will show you a summary of everything. You are about to invest $1,000 into VTSAX. And then you click Submit. And that's it. You're done. You just placed your first trade. Now, something interesting happens. Unlike a stock, where your order fills instantly, a mutual fund trade is different. All the buy and sell orders from everyone throughout the day are bundled together. Then, after the stock market closes at 4 p.m. Eastern Time, the fund company calculates the final official price for the day, called the net asset value, or NAV. Everyone who placed an order that day gets that exact same price. It's the fairest system. The next business day, you'll log into your account, and you won't just see cash anymore. You'll see that you own a certain number of shares of VTSAX. You are officially an investor. You are an owner. A tiny fraction of thousands of the biggest and best companies in the world now belongs to you. And it's working around the clock to grow your wealth. You've done it. You've taken the single most important step towards securing your financial future. But what happens now? What do you do tomorrow and the day after and for the next 40 years? The answer, surprisingly, is to do almost nothing. The hard part is over. The most difficult decision has been made. Your job now is not to be a brilliant market timer, a stock-picking genius, or a financial wizard. Your job is to be the one thing that most people fail at: patient. Your greatest enemy from this day forward is not a stock market crash, not a recession, not inflation. Your greatest enemy is the person you see in the mirror every morning. It's your own human nature, your fear, your greed, your impatience, that poses the single biggest threat to your financial success. Let me paint you a picture. It's a few years from now. You've been diligently investing, your account is growing, and you're feeling fantastic. Then it happens. You wake up one morning and the news is screaming. Market in free fall. Billions wiped out. Recession fears mount. You log into your account, and your heart sinks into your stomach. The beautiful green number you've been watching climb is now a terrifying, angry red. You've lost 10, maybe 20% of your money in a matter of days. Every instinct in your body, honed by millennia of evolution to flee from danger, is screaming at you to sell. Get out now. Stop the bleeding. Preserve what's left before it all goes to zero. Your friends are panicking. The so-called experts on TV are predicting doom. The pressure is immense. And this is the moment. This is the test that will determine whether you build wealth or destroy it. Because the secret that the wealthy know, the secret that separates successful investors from everyone else, is that moments like this are not a threat, they are an opportunity. Think about it this way. Imagine your favorite store announces a massive 50% off sale. Everything is half price. Do you run away from the store screaming? Or do you run toward it, excited to buy the things you love at a huge discount? A market crash is simply a sale on the world's greatest companies. Your mutual fund, which owns pieces of all these great companies, is now on sale. Every single dollar you invest when the market is down buys you more shares than it did the week before. This is the hidden genius of your automatic investment plan. When the prices are high, your $100 buys fewer shares. When the market panics and prices crash, that same $100 automatically scoops up way more shares at a bargain basement price. You don't have to think about it. You don't have to be brave. The system is doing the smart thing for you. It's buying low. So when the inevitable recovery happens, and historically it always has, you don't just recover. You rocket forward because you now own so many more shares, all of which are increasing in value. Selling in a panic is the financial equivalent of running out of the store during a sale and coming back to buy everything when it's back at full price. It's locking in your losses and guaranteeing you miss the recovery. Your job is to ignore the noise, trust the system you set up, and let your plan do its work. But fear isn't your only enemy. Its twin brother, greed, is just as dangerous. Let's paint the opposite picture. The market is on an absolute tear. It's been going up for years. The news is euphoric. Your account is hitting all-time highs every single week. Your friend from college just told you he tripled his money on some obscure tech stock you've never heard of. Your brother-in-law is bragging about his cryptocurrency gains. You start to feel that itch, that feeling of being left out. You start to think, my mutual fund is doing well, but it's kind of slow. It's boring. Maybe I should pull some money out and put it into that hot stock. Maybe I'm the next investing genius. This is the siren song of greed. It tempts you to abandon your sound, diversified, long-term strategy in favor of a get-rich-quick gamble. It's the voice that whispers you can time the market, that you can pick the next big winner. But for every one person who gets lucky, there are thousands who get burned. They buy at the peak of the hype right before the crash. They abandon the slow, steady, reliable ship of their mutual fund and jump onto a flashy speedboat with a leaky engine, only to find themselves stranded. The truth about building real, lasting wealth is that it's supposed to be boring. It should be as exciting as watching paint dry. You set up the plan, a diversified, low-cost mutual fund. You set up the automatic investments, and then you let it go. You let it work for decades. You let the miracle of compound interest do the heavy lifting. The whole point of a mutual fund is to save you from having to be a genius. It's to save you from your own worst instincts of fear and greed. It's a system designed to win over the long run by avoiding catastrophic mistakes. So what do you do tomorrow and the day after and for the next 40 years? You live your life. You focus on your career, your family, your passions. You check your account maybe once or twice a year, just to make sure the automatic deposits are still happening. You don't react to the daily news. You don't listen to the hot tips. You don't panic when the market drops, and you don't get greedy when it soars. You treat your investment like a tree you've planted. You don't dig it up every day to see if the roots are growing. You just make sure it gets water, your consistent contributions, and you give it the one thing it needs most: time. Decades of time. Through all the noise, all the ups and downs, all the booms and busts that will inevitably happen over your lifetime, you hold on to one simple, powerful truth. You are not investing in the stock market's daily mood swings. You are investing in the long-term growth of human innovation and the global economy. You are a part owner of the most productive and creative companies in the world. And as long as you believe that humanity will continue to solve problems, create value, and push forward, your investment will grow. This journey was never about understanding complex charts or financial jargon. It was about understanding a few simple, powerful principles. Diversify your risk. Keep your costs low. Be consistent. And above all, be patient. By investing in a mutual fund, you have harnessed a system that does all of this for you. You have put your money into a vehicle that is designed to weather any storm and capture the relentless upward march of progress. What you've truly bought isn't just a share in a fund. You've bought yourself time. You've bought yourself options. You've bought yourself freedom. Freedom from staying in a job you hate. Freedom to retire with dignity. Freedom to support the people you love. Freedom to live life on your own terms. That is the real power of what you've set in motion. Now all you have to do is let it work.